Of all of the questions that I get in real estate, some of the most frequent questions that I get are on mortgage payments. As knowing what you'll be paying is one of the most important parts of deciding to purchase a home. In this video, I will be breaking down the parts and components that make up your mortgage payment. If you're planning to go with a 30-year fixed rate mortgage, stick around to the end of the video as I will be sharing a strategy that will help you pay off your 30-year mortgage in 20 years. What's up everybody? Toby Fernie, aka the Teacher Realtor here with Coldwell Banker Realty in Monterey, California. If you're new to the channel, it is all about real estate and living here in the Monterey area. Likes and subscriptions are always greatly appreciated. It's important to understand the components and parts that make up your mortgage payment. I often get questions like, what will property taxes or insurance add to your monthly payment? When you meet with a lender, they're likely going to share with you the all-in costs and expenses in what is known as the PITI monthly mortgage payment. That is an acronym that stands for the principal, interest, taxes, and insurance. That means that your property taxes and homeowner's insurance are already factored into your monthly payments. If you want, I'm sure that your lender could break down an estimated cost for each of those expenses. But if you're feeling comfortable with that monthly PITI payment, you shouldn't necessarily have to worry about what your interest, taxes, or insurance are going to be in that payment. There are many different categories and types of mortgages, such as a 15 or 30-year fixed rate mortgage, an adjustable rate mortgage, or a jumbo loan. While each of these types of mortgages will have their benefits and drawbacks, most of the mortgages throughout the country are a 30-year fixed rate mortgage. For a traditional mortgage like this, your initial years, the majority of your payments are going to be going towards your interest rather than your principal. Your goal should be to pay off as much of your principal as you can as soon as possible. The schedule of paying off your 15 or 30-year fixed rate mortgage over time will move more so towards paying off your principal rather than your interest in the latter years of your mortgage. My recommendation if you're getting a fixed rate mortgage is to get one that does not have a prepayment penalty. This will allow you, if you're in a financial position, to pay off larger chunks of your principal in advance if you have additional money at the end of the year, or if you come into a sum of money that you'd like to put towards paying off your mortgage early. One goal that you might have would be to pay off your mortgage in a shorter period of time than 30 years. That being said, choosing a 15-year fixed rate mortgage will add to your monthly payments considerably, and you will be on the hook for making those payments each month. A strategy to pay off your mortgage early that won't put you in a bind if you're not in a financial position to make those higher payments is to try to pay off your 30-year mortgage in 20 years. A way to essentially do that is by paying 13 mortgage payments a year rather than paying 12. That way you have the option, if you have additional money at the end of the year or you're in a financial position, to make that 13th payment. Make sure that you check in with your lender or your mortgage provider and ask them to break down these payments for you and see if this is an option for you depending on where you live. If you have any questions about mortgages, if you're a seller wondering the value of your home in today's market, or if you're a buyer looking for your dream home in the area, be sure to give me a call, send me a text, or an email at toby.fernie@gmail.com. Like and subscribe. Stay tuned for future content all about real estate and living here in Monterey, California.
Click the icon to subscribe to more content from living in Monterey, California.